Hi, Pete Woodgen here from Next Level Wealth. Just catching a bit of sun down at the beach today before Tropical Cyclone Omar heads down this way later in the week, or at least the tail end of it. Today I'm going to talk a bit about when bad news can be good news for financial markets and vice versa. Now it all really depends on whether you're in the expansionary or contractionary phase of the cycle. So this week, for example, we've got wages figures coming out and unemployment figures coming out. And all things being equal, you would say, well, rising wages and falling unemployment, good for the economy, good for financial markets and asset prices. But it's not necessarily the case at the tail end of a multi-year expansionary phase of the cycle. And it very much depends on market expectations. So when you get exceptionally good release, as you see from time to time, stock markets and financial markets can fall on really good figures. And that's because they get worried or spooked that central banks will take away the punch bowl from the party and hike interest rates. So markets can like good news when you're in the Goldilocks phase, so if things are not too hot and not too cold. But it's not guaranteed, and this week I think the figures are expected to be modest anyway. So confusing? You bet. So here are three things to consider about that. Number one, the markets tend to place less emphasis on lagging indicators. So for example, Australia now has an unemployment rate of about 5%, and that's great news, but it tells us more about what's already happened in the rearview mirror than what's coming. So that's the first thing to think about. Number two is even if you knew what was coming, if you had access to inside information or a sneak preview of the economic data release, that still wouldn't necessarily help you trade financial markets profitably, because you would need to fully understand market expectations before you could anticipate their reaction. So that'll fry your brain a little bit. So the third thing to think about, and this follows on from that, is that people cannot predict the future. For all the jockeying for the title of best analyst and best forecaster, history proves conclusively that people can't predict what's coming. So therefore, logically, the more you have a strategy that relies on things going in your favor over the next month or the next week or the next quarter, the more that's really just a hit and hope approach, and eventually you'll end up nervous and disappointed. So remember, bad news can be good news, and in fact a prime example of that we'll see in Q1 this year, because plunging yields in Australia is increasingly leading to lower fixed rate mortgages for property investors. So there you go, prime example. So remember, bad news can be good news. Don't try to worry too much about short-term noise. Buy quality assets at a fair price. Don't get involved in bidding frenzies or a fear of missing out, because things can always turn on a dime. That's it for today. If you want to know a bit more, check out my website below. Go nextlevelwealth.com.au. Cheers.